The final complication with capital budgeting deals with the depreciation method required by the IRS, which is called MACRS depreciation. We know we only use future cash flows in capital budgeting decisions, and we know that depreciation expense is not a cash flow. So the depreciation expense on your financial statements are not ever relevant to capital budgeting decisions. However, you do save taxes because you get to deduct depreciation off your tax returns. The extra complication is that FASB rules for depreciation differs from the IRS rules. So we don't care at all what the FASB rules are. We always ignore the income statement depreciation expense. But what we deduct on our tax return, the IRS depreciation, is used to determine our tax savings. That means we have to talk about the difference between the FASB and the IRS's view of depreciation. FASB's goals for depreciation is simply to match the expenses to the revenues generated so that the income in any particular period represents what really happened during that time frame. Therefore, they give you a choice on the life of the asset, the salvage value you want to use, and even the method used. You can use straight line, which most companies do, but you can still use double declining balance or some other approved method. FASB's major concern is that managers may not expense enough. Managers tend to like higher net income, so the concern is they might understate the expenses. The IRS's goal, on the other hand, is simply to generate revenues for the government. That's why they are in existence. As part of their role, however, they also have policies that encourage public policy initiatives. So they allow individuals to take charitable deductions, for example, to encourage people to donate to charities. There's a mortgage deduction to encourage home ownership. So many of the IRS rules are to incentivize people to take actions that the government thinks will be good for society as a whole. The IRS's major concern is that managers might expense too much because that will save taxes, and managers tend to like to reduce their taxes. So you can see FASB's concerns about managers' incentives and the IRS's are in direct opposites. Because of this, the IRS has specific rules on how to compute your depreciation so managers don't play games. First of all, there's no salvage value on assets when computing tax depreciation. If you think about it, managers would never use a salvage value, so they'll be able to deduct the full amount of the asset cost over the life of the asset. Because of this, the IRS says that's fine. Never use a salvage value and everyone will be happy. In addition, the IRS has specific lives for each type of asset, and we'll see that in a second. The IRS specifies the method to use, and it's different from anything we use for financial reporting. So by definition, tax and book depreciation will be different. Next, the IRS specifies the beginning date of depreciation, so it doesn't make any difference if you buy an asset in January or December. You get the same amount in the first year. And finally, they have a specified rate per year, so you don't even have to do any calculations other than multiply a rate times your asset cost. The nice thing is, however, the IRS is relatively generous in the way they compute depreciation, meaning they normally expense it faster than you would for your books. The idea there is they want to encourage you to buy those capital assets, So they'll let you depreciate them pretty quickly and get that tax deduction, allowing you to hopefully buy more capital assets, which they think will stimulate the economy. The asset classes, we said it tells you how long to depreciate something. So 3-year property are small tools, horses, and research and development activities. So you can see the research and development is to encourage that. Horses, not sure if 3-year-olds are what runs the Kentucky Derby, and so you depreciate them until they run the Kentucky Derby. 5-year property, cars, trucks, computers, and office machines. So even though you might argue a computer is not going to really last you 5 years, you depreciate it over 5 years anyway. 7 years is an important one. Furniture and fixtures, agriculture equipment, oil exploration equipment. Again, you can see some lobbying components of the law here. Motorsports complexes, that's a relatively new one, so obviously NASCAR had some influence. Manufacturing equipment, and then any property not designated elsewhere. 10-year property doesn't hit too many things, mobile homes and railroad tank cars. 15-year property, road, shrubbery. I don't know, I've never had a shrub last 15 years, but obviously the IRS has a greener thumb than I do. 20-year property, wastewater treatment plants and sewer systems. And then the longer residential rental property and non-residential real property go up to 39 years. Then they give you the rates. What they use is a double declining balance method, but then it changes to straight line when it becomes more advantageous to go straight line. The other component here, if you notice, the 3-year property has 4 different lines for it. It goes over 4 years. And the reason is they use a half-year convention. So as we said, it doesn't make any difference if you get an asset in January or December. That first year of depreciation, you take 6 months, which means for 3-year property, in that 4th year, you're going to take the last 6 months. So all of the property goes 1 year longer than the number of years because you get a half year at the beginning and a half year at the end. It's not that the IRS made a mistake. Again, you use these particular rates. You don't kind of look at it and say, well, 33.33 must really be 33333333 and use more threes. You use exactly the numbers. And these are all really percentages. So that first year on 3, you take 33.33%. Let's try a quick example. Let's say you own a roofing company and are considering expanding into the home siding market. To do siding, you need all different tools than you do to do a roof. Assume it will require you to purchase $100,000 worth of those small tools. For financial statements, you will depreciate those over 8 years with a $20,000 salvage value. For depreciation for capital budgeting, we don't care about any of that financial statement information in those 8 years and that salvage value. All we have to do is go look at that table provided by the IRS that says small tools or 3-year property, and we never use salvage value with MACRS. So we're going to use the IRS table for 3 years, and anything else in that problem was just there to confuse you. Hopefully it did not. The only information we needed from that prior slide then is really just that you purchased $100,000 worth of small tools. The cost of that was $100,000. We need to get the rate from our tax tables. So those are just given, and you again use exactly the rates they show on the table, remembering that those are percentages. So you take that percentage times the cost. Notice the first year is a little less than the second because in the first year you only get a half year of depreciation. So that second year is always the biggest number. but we just multiply those. For capital budgeting, though, it's only the tax shield that relates to capital budgeting, not the depreciation itself. So we have to multiply times the tax rate, which I'm assuming is 30% again. And so our tax shield are $9,999 in the first year, and over the life we better come up with the 30,000, 30% of the 100,000 for the total tax shield. So those would be the numbers that we would use when we did our capital budgeting. Congratulations, you've got the gold star. Just remember to use your net cash flows after taxes, and that means you need to use the IRS depreciation rules for taxes, not financial accounting. So go practice.